welcome back to Brashonomics. I'm Ben Brash, and Ryan Leopold is back with us from Cobalt Mortgage with nearly $1 billion in loans funded. He's seen it all. Ryan, how are you?
I'm good, Ben. How you doing, buddy?
I'm good, man. I'm good. You know, we always get a lot of good questions from the people who are on our panel about mortgages because it does seem to be a place that, an aspect of buying a house that a lot of questions come up.
And the best questions are usually when you're off the air.
Yeah, it is. It's usually... Go figure. Anyways, so guys, I kind of want to open it up to you. Again, we have Chase and Jeff Costello along with Paul Grusha joining us. Guys, you talked a little bit before we came back on the air while we were at break about questions you guys are getting in the mortgage world. Tell us a little bit about them.
So I've got a specific question that just recently came up with a buyer who is buying a home, and he just informed me yesterday that he was putting 20%, or I'm sorry, he was putting 10% down, and he's buying a house, and owner occupied, and now he's being relocated to California, but still wants to purchase the house, but the house won't be built until after he lives in California, so he's under the impression that he can still put 10% down. Now it's a non-owner occupied property. How does that work in the mortgage world?
Well, a lot of times it comes down to the type of loan program they're going to be going for. Okay, what's the purchase price?
4.25.
Okay, so it's conforming financing. So it just be looked at as a second home, and you can do 10% down in a second home all day long. So I don't see that being a problem, even if he's not going to occupy it as his primary residence because he lives in California.
Oh, so it's not considered. Okay, I was under the impression, so that's good that I came today. I was under the impression that he had to put a larger percent down, and I told him to check with
we answer all questions here for you, buddy.
Yeah, that's good.
But that's a good question because that's one of the misconceptions that people have out there, that you're always going to be stuck in this certain box or this certain window. It's all how you package it and logically put it together. So an underwriter's like, yeah, I guess that makes sense. You're moving to California. You were going to buy it here and live in it, but you still want to buy the house. But you'll probably come up from time to time and you're going to call it a second home. Cool.
As long as they're not renting it out and actually making it an investment property.
Yes. Absolutely.
Well, you
don't want to mess with those lines, because that's when people can get in trouble if they deceive their lenders. And I think the lenders in the overall mortgage community in Washington are looking for different ways to bust lenders and consumers for being inappropriate in any way.
Makes sense. Thank you.
Yes. What else do you guys tend to see that your clients are asking on a day-to-day basis on the mortgage side?
Well, this is probably more of a question for me and how to overcome a certain objection.
You can't ask your own questions. Come on.
No, it's a question originated for me. So I have one particular...
It's a Jeffrey original.
So I've got a client who's worked... is already pre-qualified with their lender, and I won't mention Bank of America as their name.
Okay.
People love Bank of America, don't they?
Well, when we want to make a strong offer in this market, I believe the lender that we use plays a big part in that.
And I got a great story when you're done with this.
So how do I broach the subject from your perspective without downplaying or talking bad about a bank like Bank of America?
You downplay and you tell them how bad Bank of America is.
It's funny.
Do you want your buyers to get an offer?
Absolutely.
I
do, but I
will never accept
I know
that
what
offer.
I would say, but what would you say? Because I've got to convert them from using the bank that they've already been pre-qualified, that they have a relationship with, and I've got to say, we want to get this deal done, right? What would you advise me to tell them if that was the case?
This is a classic case of the passive aggressiveness we've talked about in Seattle, right?
I'm practicing telling people exactly the way I feel about things more often than in the past. So instead of being passive aggressive and being coy around that subject, I just get straight to it, because I talk to clients all the time who say, well, I've already been through Bank of America. So-and-so recommended I talk to you. Why should I work with you over Bank of America, who I've been banking with for 30 years? Okay. I worked at Bank of America. They are horrible to deal with when it comes to the mortgage side. Am I going to get in trouble for saying this, by the way?
I don't care.
Okay.
They're not a sponsor, are they?
Bank of America
on the
has nothing
lending
to do
side,
with it.
I'm very structured, very organized. I know what it takes to get through the logical process of getting someone approved in a timely fashion to assure we have that final approval to get docs out and close on a house. I went to multiple levels of underwriting at Bank of America, and I said, tell me exactly what you want to see and what progression you want to see it in, and I couldn't even get straight answers on that. So the levels of bureaucracy in big companies in general, but especially at big lenders, it's just tough to get things done. And you can imagine if you're listing a home in a competitive market and you see 10 different offers come through, all about the same offer, what lender are you going to disqualify when you see a pre-approval letter when you're listing a home?
Well, it's good because that's great that you brought that up, because we were in a situation where we received multiple offers, and I explained to the seller, we broke down all the offers, and one of the questions is we need to go with a lender who's local and who are making decisions on a local level rather than a national level. And we chose I'm not going to give specifics, but it was a big bank, and we chose not to take them because of the fear of them not being able to execute and close on time. Mm-hmm. And we chose a local bank because we knew that they could close on time. And that's huge in our business, because if you don't close on time, then nobody wins.
Mm-hmm.
Or if you don't close at all.
That's right.
Yeah, and that's the challenge. I think a lot of it comes down to the lender that you choose as far as the originating loan officer and their experience, their skill and ability, and their professionalism. Okay. But I think when you get into the banking world, that only goes so far. In my opinion, there's not a lot of good ones left in the banks because they're vastly underpaid, overworked. The standards are it's just a mess. So it's all about the quality of professional your clients are working with and the back-end support they have from underwriting and processing and getting things done in a timely fashion. So I know that some of the other banks are better. Definitely Wells Fargo's a lot better. Bank of America's is tough.
And it's hit or miss. I had a client that we actually had to ask for an extension 7 times with Bank of America. 7 times. It was embarrassing for my party, and it was embarrassing for the originator who did it, because they felt bad, but they knew that they couldn't make the decisions because they were all done out of Dallas.
So the big question is, why are you asking us if it's a good idea to steer them another way when you guys have gone through the process?
Just looking for a different angle aside from our opinions.
Sure.
So it's a great question, and it's a very valid.
Yeah.
And that seems to be one of the biggest objections that we get, trying to convert our clients from a bank that they have a relationship with.
Paul,
here's what I'd say. Before we get in that part, I would definitely say, and I dealt with this over the last couple of days, have your people get a second opinion. Even if they're stuck on their bank, their best friend, their neighbor is the loan officer, meet with another lender, get their process, and take it. Let them take you through the experience of getting pre-approved and educated about your options. 95% of the time, a good lender is going to win that relationship and start working with that client, just because the experience of working with a really good, professional, organized lender versus the average, I think is so night and day that just the experience of talking to them, I think will get them in that other direction. Because we hear that all the time, like, wow, I've never heard any of this. I've never been taught this. That is definitely unique and different, and they didn't know. They just didn't know that there's another voice out there.
Paul, what do you see going on in the condo world with with mortgages?
Well, I'm thinking and listening to everything that's going on, and one of the first things that crosses my mind, what kind of product information do you give a potential person when they come to you and say, hey, I want to buy this unit. I'm working with a great realtor, but I've got rental limitations in this property, so it kind of eliminates certain type of mortgage product that's available out there. Mm-hmm. What alternatives do you discuss that can help them get the unit that they want with a product that's going to work for them? That's because that's one of the challenges we see routinely.
So we're talking about maybe what would be considered on our part an unwarrantable condo, where maybe there's too many investment properties in the unit, maybe there's too much commercial space versus residential. Are you talking about limited financing options?
No, I'm talking about federally there are caps on, for example, when you get FHA financing or other types of financing where there are caps on rental amount of units in a building. And, of course, that's going to eliminate certain mortgage programs from individuals who wish to purchase.
Absolutely.
So with those caps that are there, we monitor very carefully the amount of renters that are in a property because, frankly, it helps track, one, what we've got for rentals, but two, it opens up opportunity then for other people who wish to buy if someone sells their unit and they may have been an investor owner or it was a second home. The challenge in that regard is they will sometimes call us looking for product, mortgage product, that they will qualify for given the quality of the building, that it has 20% rental occupied, 30% or whatever.
Yeah.
And we're finding that the pool of alternative product is drying up because of federal regulation. How do you overcome some of that, or do you have advice that you could provide that could help that potential purchaser?
So 90 to 95% of all mortgages are done what I call in the boxes of Fannie Mae and Freddie Mac and FHA and VA. Okay. And every lender, whether it's us, Bank of America, Wells, Chase, everybody else offers the same product. Okay. So as long as you keep your condo in the guidelines of Fannie and Freddie and FHA, you're going to be okay. And as long as you keep them warranted and approved, that's going to keep you appealing to the masses. So those condo projects that fall outside of that box of Fannie, Freddie, FHA, it's really limited. You're talking about portfolio lenders who will come in and look at the overall scope of the borrower and the scope of the project to basically determine risk.
Well, we've got well-qualified borrowers out there. The problem is the products aren't there for them to attach to, given the type of building they may want to move into.
It's all about risk.
It is, the total
and
risk.
We dealt with a property up north where there was 60% commercial in the whole complex and only 40% residential. Fannie and Freddie and FHA will not touch that.
And there was only 4 units. I mean, it was like a huge bottom.
That one was, there's multiple units, but it was just there's very, very limited lenders who will do it. And that's the last buyer was a cash buyer on that property. So I basically said, okay, we have very few lenders, so just be careful, Mr. Buyer. If you buy this property, when you go to sell it in the future, you're going to have limited buyers that can buy your property again. So you need to come in with that with eyes wide open. And that's where the agent community needs to understand as well that, hey, because there's limited options, you're putting your buyer possibly in a tough position unless they really love and want the property.
And from our end, we tell them we're not lenders, we're not attorneys, but we do know that there are products available out there that will fit your need. You just have to go and find them, and we'll give them some resources if we can. So it just takes a little bit more work, and I was just curious from your end what you see on a routine basis. So thank you for that. It's very helpful.
Yeah, small handful of lenders, all based on the ultimate risk of the borrower and the project.
But, going back to the Bank of America piece, that's another reason to go to a company that has alternatives. Because Bank of America can't say broker to Washington Federal, who does a lot of those type of loans. And so you end up going to a lender who is really confined by their bank rather than having alternatives that they can help somebody buy a non-warrantable condo in. So it really can be a big difference.
It can make a huge difference.
Well, it's getting the property or not is really what it can come down to.
So I have another question in regards to the condominium. If I've come across a property that has previously been FHA approved, but it's currently not FHA approved, how do you go through the process of getting it approved if we've got an interested buyer who only qualifies FHA?
Yeah, so the first thing I always recommend is that any association helps, or any association management or association works with local lenders to fill out the appropriate paperwork proactively to assure that they maintain Fannie Mae, Freddie Mac, and FHA approval standards. Okay, because that's the challenging part, is if you have one buyer looking to make an offer on a project that the whole thing is not FHA approved, we can help them with that. It's about filling out the paperwork. But I always get the impression if the association did not take the proactive approach to get it FHA approved to begin with, now you have one buyer who wants to buy in that project, they're like, oh, okay, well, they're humming about getting the stuff you need in a timely fashion. If it's not managed by somebody, it's like the working president who actually has normal jobs who manages the association on the side, they're not getting stuff in a timely fashion. So it just puts
Talking
the
about
seller...
the documents to actually get it approved when you say the stuff.
There's a lot of documents we need. I mean, a ton of stuff. So if they haven't gone through the process of proactively getting the property approved, it tells me that them getting stuff for one specific seller and one specific buyer may take some time.
And
but it's working with a lender like us.
And if you work with a professional management company for the properties that you're looking at, we have access to those documents, to those things, because we track those forms and update those forms on an annual basis to ensure, as best we can, based upon conditions in that building or in the market, that they will qualify for those FHA, VA loans based on the percentages that are allocated by the government. So
and that's
the key.
And that's another reason that people, I think, can get in trouble by something they can't control. You find a nice building, you want to go in and you want to purchase a unit in it, and then all of a sudden you realize they haven't done their due diligence to keep their approvals up with all the overriding lending companies. And certainly a way people can get screwed, just kind of like the dogs get screwed by not getting to walk around outside with kids anymore due to the iPads and video games. Guys, we got to go. Thanks so much for joining us, to all of our in-studio guests. I'm Ben Brash, and we'll be back with you tomorrow. You've been listening to Brashonomics.